Hello, everyone. Welcome to the Cornell Finance Club Education Series for Fall 2019. This first one is a retroactive recording. I decided to start screen recording education series after the plague earlier this semester knocked out a bunch of new members and made them go home to recover. So rather than reinvent the wheel multiple times, I figured it will be beneficial for everyone if these were recorded for reference back later when doing refreshers on different things or preparing for interviews. So this first one is about accounting, and I always like to say accounting is the language of finance. You really need to have a deep and fundamental understanding of this in order to really understand a lot of things that goes on in the financial services industry. So real quick, let's just go to full screen mode. And basically, we covered resume and cover letter in the beginning, but it's more helpful if you just hand upperclassmen your resumes and cover letters to evaluate, especially since a lot of y'all are freshmen where all your experiences will come off after the semester anyways. So let's just dive right into this for this post Ed Series recorded lecture and video. So first is a brief history of accounting and foundational concepts. So the General Accepted Accounting Principles, or GAAP, is established by the Financial Accounting Standards Board, which we call FASB, which relies on the following key assumptions and principles. So first is accounting entity. This just says a company is distinct from its owners. So basically, if I start a small business, it makes sense to kind of separate out the accounting for my personal expenses and the business. Or else it'll cause mixing and matching of my finances, which does not paint an accurate picture of the business I started. Next is going concern, and this just says a company is expected to remain indefinitely, which means there's nothing on the horizon that will cause itself to liquidate and sell off all its assets. There is measurement, which is financial statements are recorded in a monetary unit of where the company files reports. So U.S. companies file stuff in United States dollars. Periodicity, so company file reports annually and in interim periods, and this provides a consistent basis for comparison with both historical results and with other companies. So in terms of some principles, historical cost, companies report the value of their assets as the price for which they were acquired. So for example, if I buy a bunch of hot dog buns for 10 cents each today, and the value of that increases to 25 cents each, it still is on my balance sheet as 10 cents a pop, because everything's recorded at historical cost. And then it's revenue recognition. Revenues are recorded with earned and immeasurable. And we will talk about this later when we talk about the revenue section on the income statement. There's the matching principle, which says costs are recorded the same period as when revenue is generated. So this is termed as matching revenue with expenses. And finally, full disclosure, companies are required to provide all relevant economic information that materially affect decisions of those using the reports. So this will be seen when we go over financial reports later on. And finally, the IASB is the governing body for accounting standards internationally. FASB and the IASB tried to merge their accounting principles around a decade ago. Didn't go so well, or it didn't happen, but FASB and IASB are so similar anyways that just knowing FASB means you know most of the international accounting standards. Great, so next, the first major financial statement is the income statement. So this is a report depicting operating performance over a period of time. So the core focus is on revenue minus expenses equals profitability. So this is an important tool to evaluate the operations of a business, so growth prospects, the cost structure, and profitability. And this is used to serve as a comparison across periods or comparing performance of multiple companies during the same period. And it also has several other names, including consolidated statement of earnings, P&L statement, and statement of revenues and expenses. Finally, some major line items. So there's revenue, which is value of payment that is reasonably assured for goods and services recognized as delivered during the time period. So what this means is, for example, if someone submits an order for example, some hot dogs, that would mean that the value of the payment is reasonably assured because they've said that they would like to purchase their hot dogs. But it's only recognized as revenue when we actually deliver those hot dogs to the people who ordered them. So otherwise, it would not be counted as revenue. But we must actually physically deliver them in order to and perform the good or service in order to recognize it as revenue. So next is the cost of goods sold, and this is the direct cost to manufacture or procure a good or service. So things like hot dogs, hot dog buns would be part of the cost of goods sold of Merchant's hot dog truck. However, the other thing is like the cashier would not be a cost of goods sold, but the cook would be because the cook is directly involved in the production of hot dogs. And then you have gross profit is revenue minus cost of goods sold. Then you have selling, general, administrative. So this is operating costs that are not direct inputs. So this includes payroll, wages, office supplies, etc. And going off from the previous example, the cashier is not COGS, but SG&A because the cashier is involved in selling your hot dogs to consumers. Then you have research and development. So this is costs associated with developing new products and procedures. So for example, if someone wanted to make a new sauce to put on the hot dog, that will be considered R&D. Then you have D&A. So I bracketed out D&A here, but normally D&A is actually distributed in cost of goods sold or SG&A. So this is just an allocation of cost over fixed assets' useful life. Depreciation is physical capital assets like your stove, your cash register, and your truck. Versus amortization could be like patents, customer lists, etc. And there's different ways to calculate and different ways companies recognize D&A. So the most common is straight line. Majority of companies use this, and this is basically, let's say this truck is worth $100,000. I expect to sell this truck for $10,000 in 10 years. This means that every year it depreciates $9,000 until the last year where it's worth $10,000, where I expect I can get this truck rid of this truck for $10,000. Then you have and so this is the most common. Then you have the other ones, so double declining, which just means double declining and some of your digits. And these are just, you don't have to really memorize these, but these just reflect that depreciation happens faster earlier on in the asset's life than after. And then unit production, which is, for example, if I buy a printer, I expect this printer to, this is a printer worth $300,000. I expect to use this printer up and sell it for $100,000. And I realize that's a very expensive price for a printer. And then I expect to be able to print 2 million sheets of paper in this printer. So that means every sheet of paper I print, so every 10 sheets of paper I print, I use $1 worth of this printer if it's worth $300,000. And basically, so every sheet of printer paper I print, it's around 10 cents of the printer. So it's just using how much units you expect to produce with this asset, and that's how you depreciate it based on how many units you actually produce. So then you have EBIT, which is just gross profit minus operating expenses, and this is considered operating income. And there is a metric called EBITDA, which is EBIT, earnings before interest, taxes, depreciation, amortization. However, that's actually not used as a GAAP measure. That's actually not a GAAP measure, not recognized as by GAAP, but it's one of the more core financial metrics that are used in the industry. Next, you have interest expense, which is the amount paid on debt owed, self-explanatory. Interest income, so income from cash holdings and investments. And then you have non-operating expenses, so these are unrelated to core operations, for example, gains and loss on investments. And finally, tax expense, which is tax liability a company reports. So on the right-hand side, you can see a sample income statement that a pretend business, which is Phil's hot dog truck. But you can see here that you flow from revenue to gross profit, and then you have your operating income, going to pre-tax income, and finally net income, which is called the bottom line. And one note on D&A, again, as I mentioned, D&A is usually distributed among cost of goods sold and SG&A. So, for example, depreciation of your stove will be in cost of goods sold because a stove is used to make hot dogs, but a depreciation of your cash register would normally be included in SG&A because it's used to sell your hot dogs. I just listed out separately here to show off the what's to show off the expense, but normally most companies don't actually section this out on the income statement, but it's separately sectioned out on the cash flow statement. Cool. So now let's move on to revenue recognition practice. So which of the following are considered revenue? And just pause this video and I'll give you a few seconds. So basically, A, Murta's hot dog truck collected $2,000 in cash from a local grocery store for hot dogs previously ordered and delivered. So this is not revenue because cash collection does not mean revenue. They recognize revenue when they delivered them because they ordered it and they delivered. But this is just $2,000 in cash afterwards. So this gets talked about more on the balance sheet, but basically it was probably bought on account and they received $2,000 from it in a later date. B, 30 school children bought hot dogs worth $100 from Murta's truck during a field trip. So this would be considered revenue because the children bought hot dogs for $100 during a field trip. So this is a direct sales activity. C, Barwin's souvenir shop ordered $200 worth of hats from Murta's hot dog truck, which was subsequently delivered. So again, this is the definition of revenue. They are ordered, so payment is reasonably assured, and then Murta delivers the hot dogs or the hats, which means that they delivered it, which means the transaction was completed, and thus it is recognized as revenue. Received $20 of interest income from the company checking account. This is not revenue because it's interest income. And then sued Auntie Anne's, winning $5,000 for using the recently developed sauce without permission. So this is not revenue. This is not related to their core operations, but it does represent them getting $5,000 in cash. And yep, B and C. And next, this is expense recognition. So what expenses, COGS, SG&A, or other are the following considered as? So A, $3,000 worth of meat and buns were used to generate revenue. So this is COGS. It's direct inputs to the good. Used up $200 worth of paper when printing receipts. And this is SG&A used in this operating and selling of the hot dogs, but not in the direct input costs to produce it. Pay the part-time cook a monthly wage of $2,000. This is COGS. A cook is used in the direct production of hot dogs. Pay the cashier $1,000. This is SG&A. Cashier sells the hot dogs. Spend $200 on flasks to discover the true essence of the perfect hot dog. And this is R&D, so other, because you're researching, developing an innovation that can improve your business. Spent $300 restocking the condiment supply. So this is other, and it's actually not an expense because you spending $300 restocking inventories is not actually expense. Because note our revenue recognition expense principle, you match revenue with expenses. So because these condiments have not been used up yet in terms of revenue generation, they're not expense. And this is a more balance sheet concept, which we'll discuss later. And then G, recognize $100 depreciation on a grill used to make hot dogs. This is COGS. Depreciation on the grill is a direct input cost to hot dogs. Again, here are the answers. And now let's move on to the balance sheet. So the balance sheet is to report the company's assets and how they are funded. So liability and stockholders' equity on a particular date or a particular point in time. So this is usually a financial snapshot at a set point in time to evaluate health of the company, which contrasts with the income statement and later a cash flow statement, which analyzes the company's operations over a period of time. So if you take away anything from today, the fundamental accounting equation that must balance is that assets is equal to liabilities plus stockholders' equity. So the company's assets and how they're funded. So major balance sheet line items. So first, cash and cash equivalents. So this is your cash, so held in bank accounts, or this could be securities that are owned by the company. So sometimes you can see that, like, if you hold a government bond that matures in 30 years, that is still considered a cash equivalent because you can easily sell the bond for cash really quickly. You have accounts receivable, so this is payment owed for products and services that are already delivered. So alluding back to your earlier example, like this is called buying account. If a grocery store buys some products from Murta's hot dog truck for like $5,000, and they will sometimes have agreements where you'll deliver the goods you don't need to be paid for the next like 60 days or so, for example. Then this goes into accounts receivable because that's $5,000 of things that are sold but you have not collected money from. So revenue is recognized, but the cash has not been collected. Next, you have inventory, so this is goods waiting to be sold. And next, prepaid expenses. So that's rights to future services. So for example, if Phil Murtha buys $50,000 of fire insurance for his truck for the year of like 2020, for example, that means that this is an asset because you're owed this service in the future, this insurance service, but you have not used it up yet because again, you match revenue with expenses. You only recognize this as expense when you operate during the month that the insurance covers. So these are considered current assets, and again, current assets are listed from most recent, how most recent they can be converted into cash, to the most distant. So current assets are things that can be turned into cash within a year, while non-current assets are more than a year. So then the most common non-common assets are PP&E. So this is land, building, and machinery owned by the business to support its operations. You have intangible assets, which is just non-physical patents, trademarks, which is the intangible, like parallel to PP&E. So moving on to the liabilities, again listed from their order. So they're listed from the order of maturity. So basically, when they come due, that they need to be paid back. So again, current is less than a year, and non-current is over a year. So intangible assets, so accounts payable, this is amount owed for items already purchased. So this is the flip side of the accounts receivable. So for example, let's say Murtha's hot dog truck buys buns on account. This just means that, let's say you spent $10,000 buying supplies, but you had yet to pay your supplier. This is recognized as you are restocking your supplies, but because you have not paid down that money you owe them, that $10,000 gets recorded into accounts payable. Next, you have accrued expenses. So expenses incurred but not yet paid. So for example, like if your like cook works for you every month, and also you have a policy where you pay a salary bi-weekly, then like a cook working for 2 weeks but have not yet been paid that money means that it's recognized as accrued expenses because you've accrued that expense, so you owe that, but you recognize that as expense already, but you have not paid your cook the money, so therefore it's considered a liability that you must pay and are obligated to pay in the future. Next, unearned revenue. This is just cash received for product and services not yet provided. So for example, magazine company. Many magazines have an option where people can subscribe up front and pay for the next 12 issues. So you might get like $100, $200 for 10 issues. However, since you got $200 for 10 issues and you have not delivered any because issues come in like monthly, for example, that means that you have $200 of unearned revenue. So you've received cash for product, but you have not yet provided that product or service yet. Next, short-term and long-term debt. Again, this is just bank loans and other forms of debt whose maturity is within a year for short-term and exceeds 1 year for long-term. Moving on to the total stockholders' equity. So basically, there's not much. We'll be going over this in depth more when we talk about enterprise value. However, for this, what you have to know for now is that there's common stock, so capital received and company issues shares, and then retained earnings. So this is how the income statement connects to the balance sheet. Net income flows into owner's equity through retained earnings. So revenue increases retained earnings while expenses decrease it. As you can see from the right, here's a sample balance sheet. You can see that total assets equals total liabilities and shareholders' equity. So everything is good in the world. So on a balance sheet, there's a concept called double entry accounting. So each transaction the company does affects the balance sheet in two ways to make it balance. And basically, you can see that assets equal liabilities and owner's equity. Assets, and this is just accounting terminology, assets increase with a debit and decrease with a credit. So basically, an increase in cash means a debit to cash, while a decrease in cash means a credit to cash. On the flip side, liabilities and equity, debit is a decrease to liabilities, while credit is an increase, and same as equity. So you can see that not only do assets equals liabilities plus equity, you can see that debits and credits also must balance. Whenever there's a transaction, and just on the balance sheet in general. So just to go over a few examples, so Phil invests $10,000 of his own money into Martha's hot dog truck. So here, cash is debited because it's an increase of $10,000 in cash, and equity is credited because because he put in money, he gets $10,000 and to his name that he owns the stake in the company. So that's $10,000. Next, you can see that you can have the modification on the same side of the balance sheet. So Martha's hot dog truck uses $40,000 in cash to purchase a truck. So the truck is debited by $40,000 because it's an asset and you just got a truck, but cash is credited because it's a decrease in cash. So you minus $40,000. Cool, so now let's do some double entry practice. So first, Martha's hot dog truck takes out a $20,000 loan due in 7 years from Bank of America. So here you took out a loan, so your cash gets debited by $20,000, and your liabilities or your debt gets credited by $20,000 because it's an increase in cash and an increase in debt. B, the Joseph the cook is paid his $2,000 in wages for his work over the last 2 weeks. So here you can see that because he is owed wages, this means that the expense has been accrued. So therefore you credit cash $2,000 because you're decreasing cash $2,000, but you're also debiting your liability, which is accrued expense of $2,000, so that your balance sheet balances. Next, Martha's hot dog truck received $4,000 of buns from Laura's bakery, but has yet to pay. So here, this is a classic example of accounts payable. You got $4,000 in buns, so your inventory goes up by $4,000. But because you have to pay, this means you bought them on account. So therefore, your accounts payable account goes up by $4,000. So it's a debit to inventory of $4,000 and a credit to accounts payable of $4,000. So D is a trickier one. Martha's hot dog truck delivered hot dogs using up $200 of buns and meat for Eric Zhou's frat party. They recognized $400 in revenue, and then I forgot what his frat is, and I don't read Greek, so his frat has yet to pay Martha's. Assume no other expenses were incurred. So here you can see that Bill recognized $400 revenue. There are $200 worth of expenses, and Eric has yet to pay. So from here you can see that accounts receivable is debited by $400 because Eric has yet to pay. Next, you can see that inventory is credited by $200 because $200 of inventory are used up. And next, remember what I said on the income statement. The revenue increases return earnings, and the expenses decrease return earnings. The return earnings is an equity account. So because $400 of revenue recognized, the equity account gets credited $400, and because we recognize $200 of expenses, equity is debited by $200 for a net change in $200. So I can see the debit still equal the credits in this exercise. So that is how double entry accounting works. And note, it doesn't really, this part is just for understanding. It's not really meant to really, it doesn't come up that often later on doing financial analysis, but it's just to increase understanding of how the balance sheet works. And finally, the last statement is a cash flow statement. And this kind of provides insight beyond what the income statement provides, and it's namely ability for a company to generate cash from various activities. So a company can show high profitability, but can be running out of cash because significant of their portion of their revenues can be non-cash. So for example, if you have a massive accounts receivable account and it takes so long for people to pay you, you might run out of cash and it might not show your company is not in perfect financial health. So thus, the cash flow statement reconciles net income to a company's actual change in cash balance over a period of time. And this is important because companies need cash to run their business. So the bottom line of net income of the income statement is the top line of the cash flow statement. And then non-cash adjustments are made to it. And then the operational line items from the balance sheet are reflected on cash flow statement as well. And you can see that changes to the balance sheet are reflected in the cash flow statement. So you can see that here are the sections of the cash flow statement. And normally this is what we call the indirect method of calculating cash. So this is basically you start from net income and then you make adjustments to it. And this is most common in current accounting practices. On the other hand, there's something called a direct method, which you just see the cash impact of each transaction and you add them up together. So next week we're going to go over an exercise on accounting, and you can see the differences in how exactly this works. So with the cash flow from operations, the goal is to adjust net income for non-cash expenses, and basically you need to reflect the changes in working capital or operating assets and liabilities. So basically, and this just means assets and liabilities tied up in the normal operations of business. So what I mean by that is that accounts receivable is an operating asset because let's say someone buys something from from you, you need somewhere to store the revenue until you get paid in cash. So it's considered in the company's core operations. So basically, you can see that from here, an increase in asset means a decrease in cash, while an increase in liabilities is a gain of cash. So basically, for example, in inventories, you need to spend money to fund your assets. So that's the use of cash. Versus with accounts payable, let's say you buy those inventories, but you put some of that on account. This means you didn't need to spend money to actually be able to pay to acquire those assets. So it's a gain of cash. And on vice versa, let's say you finally paid down your liabilities. That's a use of cash. And if someone gives you money from, for example, accounts receivable, so the decrease of accounts receivable means you just gained cash. Hence why they are flipped, and you subtract out increase in accounts receivable, but you add out increase in accounts payable and other liabilities. So that gets you to your cash flow from operations. Next is the cash flow from investing activities. And this just tracks additions or reductions to fixed assets and investments during a year. So common law items include CapEx, which is capital expenditures, so amount of money you spent on your properly planned equipment. Purchase of intangible assets, so the intangible flip side to capital expenditures. Proceeds from asset sales or loss from asset sales, and then purchase and sales of marketable securities. And finally, the bottom part is cash flow from financing activities, and this just tracks changes in the company's sources of debt and equity financing. So common line items include issuance/repayment of debt, the issuance/repurchase of common stock, and then issuance of dividends. So one special note about dividends, so retained earnings is increased by net income, but is decreased by dividends because you're paying out the company's earnings and returning it to shareholders in the form of dividends. Great, so that is all for today. We'll be doing exercises in the future sessions and just going more and using all these concepts in terms of our evaluation later on during the semester.